Welcome guys, my name is Artem. I am a CPA and managing partner of Torrent Accounting. One of the most common questions we hear from small business owners is, do I need a bookkeeper or a CPA? The confusion is understandably because both roles deal with your company's financial data, but they actually serve very different purposes in the business. A bookkeeper focuses on recording financial transactions, while a CPA interprets those numbers and helps guide strategic financials decisions. Understanding the difference is important because hiring the wrong professional at the wrong time can lead to poor financial decisions, tax issues, or missed opportunities. Today, we're going to be explaining the difference between a bookkeeper and a CPA and when your business should use each one. To begin, let's start with the role of a bookkeeper. A bookkeeper is responsible for maintaining accurate financial records for your business. Their primary job is to record and organize the day-to-day financial activity of your company. Typical bookkeeping responsibilities vary, but they can include recording income and expenses in your software, categorizing transactions correctly, reconciling bank and credit card accounts to make sure you're not missing any transactions, tracking your invoices and payments, maintaining the general ledger. In simple terms, to break this all down with all this jargon, a bookkeeper ensures that every financial transaction in your business is properly recorded and organized, which is extremely important. Without this foundation, it becomes extremely difficult to understand the financial health of the business. But most importantly, without accurate books, your CPA can't properly prepare your tax return or provide any kind of meaningful financial advice regarding tax planning or any other questions you may have and what you need to be looking at your business. So what does a CPA actually do? A CPA, well, to explain that, that's a certified public accountant, operates at a higher analytical and strategic level, typically. While a bookkeeper records financial activity, a CPA interprets and analyzes that financial data. A CPA typically helps with tax preparation and compliance, tax planning and strategy, financial analysis and reporting, business structure, how you're structured. You can even incorporate long-term financial planning. Where do you want to be 5, 10 years from now? And what would that look like? In other words, a CPA uses the information produced by the bookkeeper to help business owners make smarter financial decisions. A CPA will look beyond the transactions themselves and focus on those numbers and what they mean for the future of your business. Next, we're going to cover a little bit of the difference between education and licensing requirements and the differences for both professions. Bookkeepers generally do not require a state license to perform bookkeeping services. However, there are certifications. Some may have certifications, but it's not a regulatory requirement. CPAs, on the other hand, or certified public accountants, must meet strict professional standards. Typically, those are state assigned and there's national certifications too. They must pass the CPA exam, meet state licensing requirements, and complete ongoing continuing education year after year. CPAs are also legally authorized to represent clients before the IRS in audits and other tax matters. This difference is one reason CPAs typically provide more advanced advisory and compliance services. So you may be asking yourself, when does a small business need a bookkeeper? The reality is, most small businesses will benefit from having a bookkeeper once they begin generating regular transactions. If your business is producing revenue, paying expenses, and managing invoices, accurate record keeping becomes it's a non-negotiable, it's essential. A bookkeeper helps maintain organized financial records and ensure that everything is ready for reporting, tax preparation, and tax planning. Without consistent bookkeeping, businesses will often run into problems. And those problems vary, but they can be, it can be poor financial visibility, cash flow confusion, tax preparation delays, or just inaccurate financial reports. So the next logical question would be, when does your business need a CPA? And a CPA becomes important when financial decisions start becoming more complex, or you're not confident in your compliance with the business. Business owners often turn to CPAs when they need help with tax strategy, entity selection, financial forecasting, if you need to be represented before the IRS, if there's ever notices or an audit, if you need to be compliant with tax laws, as I mentioned, preparing and filing business tax returns. Those get a lot more complicated than just an individual tax filing. A CPA's role is not to just file taxes, although those do exist. A good CPA will help your business minimize tax liability, reduce risk, and plan for future growth. The point in all this is most businesses need both. They need a bookkeeper and a CPA. The key point is that these two roles are not replacements for each other. They actually work best together in synergy. A bookkeeper maintains clean and organized financial records, and then a CPA will then use those records to provide insights, planning, and compliance guidance. Nobody wants to be dealing with any kind of tax authority. When these roles are working together properly, business owners gain both operational clarity and strategic financial planning. In my closing remarks, the difference between a bookkeeper and a CPA ultimately comes down to this. A bookkeeper records what's already happened in your business, so it's more of a reactive compliance piece. A CPA will help you understand those numbers, what they mean, and how to plan for the future. And both are critically important. They simply solve different financial problems for your business. Again, my name is Artem, and thanks for watching.